Most people dream about investing. They imagine growing their money, building wealth, and having a better future. But the sad truth is this: many investors fail before they even take their first real step. They don't fail because the stock market is too hard or because investing is impossible. They fail because they start the wrong way, with the wrong mindset, or with no plan at all. Understanding these mistakes can help anyone start the right way and avoid the traps that hold so many people back. One major reason people fail early is that they have no clear plan. They begin investing the same way someone might walk into a forest without a map. They don't know where they're going, why they're going, or what they'll need along the way. A good investing plan answers basic questions like what they're investing for, how long they'll invest, how much risk they can handle, and how much they can put in each month. Without these answers, people end up making emotional choices. When prices rise, they chase. When prices fall, they panic. A plan gives direction, and without one, people quit before they even begin. Another reason people fail before starting is because they expect fast results. Many beginners believe investing works like a quick money machine. They hear stories about someone who made a lot of money in a short time and think that's normal. But real investing doesn't work that way. Investing is slow, steady, and patient, more like growing a tree than winning a race. The real secret to growing money is time. It takes years for money to compound, grow, and multiply. Because beginners don't see quick results, they often think they're doing something wrong. They lose hope, stop investing, or jump into risky choices trying to make their money grow faster. Their expectations don't match reality, and that causes early failure. Another mistake many people make is following hype instead of wisdom. Many new investors don't start with research. They start with social media. They listen to popular voices who speak loudly but don't explain real risks. This leads people to chase trends, buying whatever is hot at the moment. When you follow hype, you usually buy at high prices and sell at low prices. This kills confidence and leads to losses. Wise investors study what they invest in. They know what they own and why. Beginners who skip this step often fail early because they never build the knowledge needed to make smart choices. Some people fail before they begin because they misunderstand risk. They think risk means danger. They fear losing money so much that they avoid investing completely. But doing nothing carries its own risk. Holding money in savings means it grows very slowly, and inflation makes that money lose value over time. People who wait for the perfect time to start often miss years of growth. Other people do the opposite. They take too much risk. They jump into things they don't understand, hoping for big returns. When the investment drops in value, they get scared and quit. Both groups fail because they don't understand that risk is not the enemy. It is part of the journey. Many beginners fail because they don't take time to learn the basics. They don't understand how the market works, what a mutual fund is, or how compounding works. Without understanding, investing feels scary and confusing. When people don't understand something, they can't trust it. And when they can't trust it, they either never start or they start the wrong way. Learning just a few simple principles can help anyone avoid the early mistakes that cause so many people to fail. Education builds confidence, and confidence leads to consistent action. Some investors fail early because they try to time the market. They wait for the perfect moment to invest. They wait for prices to drop or for the economy to get better. But there is no perfect moment. Trying to pick the perfect time usually leads to doing nothing, overthinking, or missing opportunities. Successful investors understand a simple truth: time in the market matters more than timing the market. The sooner someone starts, the longer their money has to grow. The last major reason people fail before they begin is mindset. Many beginners think investing is all about picking the right stock or finding the next big company. But successful investing is really about discipline. A good investor learns how to stay calm during market drops, stay consistent during slow years, and avoid emotional decisions. Without these habits, most people fail early because their emotions control their choices. A strong mindset helps a person stay on track even when the journey feels slow or difficult. Most investors fail before they even begin, not because the market is broken, but because their approach is broken. They start without a plan, expect fast results, follow hype, fear risk, and don't take time to learn the basics. But with patience, knowledge, and a long-term mindset, anyone can avoid these early mistakes. Success in investing doesn't start with money. It starts with understanding. It starts with the plan. It starts with the right mindset.